there, and welcome. In today's explainer, we're going to demystify a really crucial tool for any business that actually makes things, the manufacturing account.
Welcome to Mind the Gap, where we balance your accounting knowledge.
So, let's kick things off with a big question. Think about it. If your business actually makes stuff, in a factory, how on earth do you separate the cost of making those goods from all the other costs of just running the business? Things like marketing or paying the admin staff? Well, that's the exact problem the manufacturing account is built to solve.
Here's how we're going to break it all down. First, we'll get into the why, its purpose. Then, we'll look at the building blocks, the core costs. After that, we'll walk through a standard example. And then, for the fun part, we'll level up and show you how to add a profit into the mix.
All right, so first up, the why. You've got to think of the manufacturing account as this super important first step. It's the groundwork a production business has to lay before it can even think about creating its main financial statements, like the profit and loss account.
So, what exactly is it? Well, the manufacturing account is a special statement that's all about calculating one single, crucial figure: the total cost of goods manufactured, or what we all call COGM, for a specific time period. Basically, it acts like a bridge. It takes all that messy data from the factory floor and turns it into one clean number that the main accounts can actually use.
Okay, now that we get why it's so important, let's get into the nitty-gritty. We're talking about the building blocks, the core costs, and formulas that really make this account tick.
The whole process really just boils down to 3 key steps. First, we figure out the prime cost. Second, we add in all the factory overheads to get the total factory cost. And third, we make a final tweak for something called work in progress, or WIP, to land on our final number, the COGM.
All right, first on the list, prime cost. This is the absolute foundation of your production cost. It's the sum of all the direct costs, the stuff you can literally point to in each thing you're making. We're talking about the raw materials, the wages for the people physically building it, and any other direct expenses, like, say, royalties.
Okay, so once we've nailed down the prime cost, we zoom out a bit to find the total factory cost. All we do here is add in all the indirect costs. Everything else it takes to keep the factory humming that isn't tied to one specific product. Think about the factory supervisor's salary, the rent, or the depreciation on the machines. And that brings us to the grand finale, the cost of goods manufactured. This is the number we've been working towards. We take our total factory cost and then adjust it for that work in progress we mentioned. So we add the value of any half-finished goods from the start of the period and subtract whatever's still on the line at the end. What you're left with is the total cost of only the goods that were fully completed and are now ready to be sold.
Okay, that's enough theory, right? Let's get our hands dirty and actually put this into practice. We're going to build a manufacturing account from the ground up using some data from a company called Chipu Conte Enterprise.
So, what you see here is all the financial data we'll need for Chipu Conte's enterprise. You can see we've got everything from raw materials and purchases to factory wages and other expenses. All right, let's start piecing this puzzle together. So step 1 is a big one, figuring out the cost of the raw materials we actually used up. We take our opening stock, add our purchases and shipping costs, and then subtract what we didn't use, our closing stock. And voila, that gives us a materials consumed figure of $140,500. Awesome. Now we build right on top of that. We take that cost of materials, we add in the direct manufacturing wages of $80,000, and for this company, we also add direct expenses for royalties, which were $36,000. And there we have it, our first major milestone, a prime cost of $256,500.
Next up, we need to add in all those indirect factory costs, the overheads, right? So this includes things like the depreciation on machinery, the factory insurance, and other general expenses. Tossing those on top of our prime cost brings us to a total factory cost of $331,500.
And now for the final step. We make that super important adjustment for work in progress. We add the opening WIP of $29,000 and then subtract the closing WIP of $25,000. And that gives us our final answer. The cost of goods manufactured, the big number that gets passed along to the trading account, is $335,500. All right, you ready to level up? Let's take this a step further. Sometimes a business wants to treat its factory almost like its own little company, a separate entity that actually earns a profit. When they do this, the goods aren't just moved over to the sales team at cost. Nope, they're transferred at a higher price. So you might be asking, what happens when a company wants to do that?
Well, they bring in this concept called a transfer price. And what this does is it allows them to measure how efficient and profitable the factory is all on its own.
Now, the key thing to understand here is the difference between these two values. On one hand, you have the production cost, or COGM, which is the actual cost to make the stuff. But on the other hand, you have the transfer price. Think of this as a kind of market price that includes a built-in profit margin for the factory. It's basically what the factory sells the goods for to its own company's sales department.
Okay, so this part often requires a little bit of quick math, but don't worry, it's pretty straightforward. In our next example, a company uses a 20% profit margin on sales. But remember, the number we're starting with is the cost of production. So we have to convert it. Just think, if sales is 100% and the profit is 20%, then the cost has to be 80%, right? So to find the profit as a percentage of cost, we just take that 20 divided by 80, and that gives us a quarter, or 25%.
And here's what that looks like in action. You can see the account is put together just like the last one, and we get a cost of goods manufactured of $151,550. But then, and here's the new part, we add that 25% manufacturing profit, which works out to $37,887.5. This gives us our final transfer price of $189,437.05. And that's the number that gets sent over to the trading account. See the difference?
Okay. Whew, that was a lot. So let's do a quick recap of the key takeaways. First, the manufacturing account's whole job is to calculate the cost of goods manufactured. It does this by starting with prime cost, adding in the overheads to get the factory cost, and then making that final adjustment for WIP. And, as we just saw, you can use a transfer price to treat the factory as its own profit center.
Look, if you remember just one thing from all of this, make it this. The manufacturing account is that crucial link. It takes the complicated, messy reality of a factory floor and translates it into a single, clean number that is absolutely essential for figuring out a company's overall profitability.
And that leaves us with a final question to chew on. Beyond just checking on how the factory is doing internally, how could a manager use this idea of a transfer price to make a big strategic decision like whether to make or buy a component? Seriously, think about it. If your factory's transfer price for a part is higher than what you could just buy it for from an outside supplier, what does that tell you? It's a really powerful tool for thinking strategically.